And that's where a lot of change will happen, Rima.
Okay, so you see the road sector bubbling. Stay on, Prakash. We want to talk about the technology space. On Friday, Accenture reported the Q1 FY23 numbers. The results were very strong, beat on the top line, but the company has gone ahead and maintained its full-year guidance. The stock was down 6% on Friday, and over the last two trading sessions, Accenture lost close to about 10% of its value. Girish Pai, the head of research at Nirmal Bang Institutional Equities, is now with us on the show. Girish, first, your key takeaways from the Accenture numbers, the commentary, and the read-through for Indian IT.
First of all, thanks for having me on your show. So I think the numbers, the results per se, in my opinion, portend difficult times for the Indian IT service industry going into the next 12 months. So the thing about Accenture is that its year ends in August. So the guidance they're giving for the full year, the second half actually coincides with the first half of FY24. So you're kind of getting a peek into the kind of number, the growth numbers that we could potentially see for the Indian IT service industry. So when you look at that, the numbers don't look too great. So for the full year, if you look at the organic growth guidance that Accenture has given, that's about 7% versus that 21% kind of number that it clocked in FY22. And when you kind of split the first half versus second half, the sense I'm getting is that you're going to see somewhere close to low single digit to mid single digit kind of organic growth for Accenture in the second half, which kind of, as I said, coincides with the first half of the Indian companies. So that does portend difficult times for the Indian industry. That's point number one. Second, what I am a little concerned about is the very strong performance that Accenture has shown on the managed services side. This is the piece of the business where I think Accenture actually competes with the Indian players in a much more meaningful way. And I don't know whether this is the demand situation or that there's a market share shift that's kind of happening in favor of Accenture. So that is, I would probably say, the second concern I have. Third would be about, I would say, the smaller deals. I think you did make a mention of that. What it says, and this is something that was mentioned by even Cognizant about 6 months back, that smaller deals in the pipeline are fewer in number. And if you look back in history, both tier 1 and tier 2 companies have both benefited from smaller deals. For instance, Wipro in FY22, you had a situation where it did not clock too much of TCV, but it showed very strong growth. And one of the reasons why it said it did well was because the strong flow of smaller deals. And tier 2, you had instances of LTI and Mindtree, which didn't see very strong TCV growth. Even they delivered very strong growth because of the smaller deals. So I think that could be a bit of a challenge for tier 2 companies and even for the tier 1 companies. And lastly, while attrition has kind of come off very dramatically, my sense is that the very strong net hiring relative to what it did last quarter does indicate that probably companies have overhired and probably misjudged the extent of demand. And that could mean a challenge in terms of how do you kind of deploy the human capital going forward, which could mean involuntary attrition, some sackings happening in the next 3-4 quarters. So that's broadly the sense I have of the industry.
Hi, Girish. Good morning. Nigel on this side. You know, Girish, I've got that call pretty much right? You've been a little bit cautious on the IT space, and that's played out well. Now, you've given us a few factors as well that are at play. My question to you is, how much more for correction on the tier 1 companies will make you change your stance? Will it be a 15% correction from year on? That will, get you a little bit more constructive.
Yeah, Nigel, my sense is that the street is still not, put in the, even I would say normal bear case situation in their numbers. So when I look at my estimates for FY24, I'm kind of building in low to mid single digit kind of US dollar revenue growth for the tier 1 companies. Whereas I think the street is broadly building in high single digit kind of number. And my sense is that the street is building in a little bit of margin expansion going into FY24, which I think is unlikely because I think there's going to be a little bit of pricing pressure. And also there's going to be on-site salary cost increases that are going to come through, which will mean that margins at best are going to be flat versus FY23. So earnings have to come off. And from a P/E multiple perspective, as we speak today, the multiples are fairly expensive compared to history. And when I talk of history, I'm talking the pre-pandemic timeframe, where tier 1 stocks are trading between 15 and 20 P kind of multiple on a forward basis. we are probably in that 25, 26 kind of a forward PE multiple at this point in time. And you also need to take into consideration that 15 to 20 PE multiple pre-pandemic phase was when you had a zero interest rate regime globally. I don't know how things are going to pan out on the interest rate side, but fairly unlikely that you'll actually see zero interest rate going into the next 5 years. So I would think that the stocks have to correct anywhere between 20 to 30% from here for them to kind of reach levels, which in my opinion will lead to some meaningful kind of returns kind of coming through for the tier one stocks.
Okay, 20 to 30% correction from here on. This is over and above the 25% knock that we've seen in 2022 so far. Girish, you said your estimate is that the tier one IT companies will see a low to mid-single digit kind of revenue growth next year, right? FY24?
Right.
So that would be exactly the pre-COVID levels, right? Pre-COVID, FY17 to FY20, IT companies had a revenue growth of 5 to 8%. So the fact that growth is going to go back to pre-COVID levels and the interest rates are a lot higher than what they were pre-COVID, what should the valuations be? Should they be even lower than what we had pre-COVID?
Ideally, they should be, but I don't want to sound too bearish at this point in time. So yeah, from a growth perspective, just for FY24, my sense is that the growth is going to be a bit compressed because of the bad macro environment we're going to see in both US as well as in Europe. So we're going to see probably a valley kind of a situation develop in terms of growth rates. So FY24 is going to be the lowest part of the valley. And then probably in FY25, we're going to come out of it. Now, how strongly we're going to come out of it is dependent on whether we're going to see inflation come off to like 2% levels and Fed go into a significant monetary stimulus, say 12, 18 months down the road. So that is the call that we'll probably have to kind of wait. So my sense is that FY24 is going to be the low point from a growth perspective, and things should pick up from there in FY25. And my sense is that with this whole digital transformation that's kind of playing out in a compressed form, which is what Accenture keeps talking about, we should see slightly better growth than the 7-8% growth we saw pre-pandemic. So it should be a little better.